Can you hear me?
Yes, sir.
Yes, sir. Okay. Right. Today also is all in head, but I could not make PPT presentation. Okay, but I'll be speaking. Okay.
Okay.
Do you have, right? You don't have material. Do you have material, Vignani?
No, sir.
Don't have material. Okay. Okay. Okay, no problem. We'll talk about the construction of the index. Okay.
Okay, sir.
Index, index. Sensex
Sir,
index,
your voice is stucking.
Hello.
Sir.
Can you hear me?
Yes, sir.
Clearly?
Yes, sir. Now it's okay.
No idea. Okay. So what is the sensitive index mark now? What is the sensitive index mark? Bombay Stock Exchange index. How many points I need to ask you? How many points can you search in the Google and tell me?
Yes, sir.
And likewise, National Stock Exchange.
It's 59,744.88.
59,000.
Yes, sir. 59,744.
Around 60,000. Nearly 60,000.
Nearly 60, sir. Yes, sir.
Yeah, nearly 60,000. Okay, and likewise, NSE, National Stock Exchange.
It's 17,822.
17,822. Okay. Now, how these indices increase or decrease? That's our concern. That is our point of discussion for now. Okay. So, there is a base year. What is the base year for Bombay Stock Exchange? Please check it. Base year for Bombay Stock Exchange.
It's 1978 to 79.
1978-79. Okay, 1978. And at the base year, what was the index set at? I should ask you this way.
Base value?
Base year is 1978, na?
Yes, sir. 1978-79.
Then The second revision of the base year, next revision of the base year. It is revised. Revised base year for Bombay Stock Exchange sensitive index.
Revised year.
Revised base year for BSE Sensex. Revised base year is not coming?
No, sir.
Okay, okay. Let us say, how many stocks are listed in 1978? Stocks listed in 1978 at Bombay Stock Exchange. Stocks listed in BSE in 1978. Did you get it? Stocks listed in Bombay Stock Exchange. Is the net slow or what?
I am not getting, sir.
Okay. Okay. Then leave it if you're not getting. Type another sentence. Steps in index construction.
1 second,
Steps
sir.
in.
What, sir?
Steps in.
Steps in
Sensex construction at BSE. Sensex construction at BSE. Steps in.
It's like the methodology used.
Methodology used. Okay. Yeah, methodology used also is okay. Is it open?
Yes, sir.
Okay. Now, what is the heading given there? Methodology only. Main heading.
Sensex calculation.
Main heading. What is the first step, first point, first side heading?
Okay, steps involved in Sensex calculation. First is the BSE Sensex stocks are the list of top 30 companies that are shortlisted on the basis of criteria like total market cap, free float market cap, etc.
Okay. Yeah, 30 stocks that are listed in Bombay Stock Exchange. Next.
Yeah, I mean 30 companies. That is the only thing, sir, you asked.
30 stocks means 30 companies. 30 stocks means 30 companies.
Yeah, I was confused by these things.
30 stocks means 30 companies.
Stocks is number of companies.
Stock means company only. You know, company stocks. 30 company stocks.
Yeah.
Okay.
Next point.
Next step. Next point.
These companies are from sectors like banking, IT, FMCG, etc.
Okay. Next.
Now
Next.
the market
Next.
cap. Now the market cap and the free float market cap of each of these 30 companies is determined. Next step, the market cap is multiplied by the free float factor to find the free float market cap.
Okay. Okay.
Then the free float market cap of these 30 companies is added to get the total free float market cap. Now the following formula is used, like total free float market cap divided by base market cap into base index.
Okay. So, did you understand anything?
I was not aware of this free float market cap.
No, not even 1%. You understand, right?
I understood that there will be a 30 companies, top 30 companies will be listed in.
That is great. Okay, at least that point, if you understood,
and
that's
which
excellent.
These companies include like banking, IT, and other things.
Okay, great. So it is like this. Let us say there are 30 companies registered, and 30 each company may have different face value of the share. Let's say some companies have a face value of 1 rupee. Some companies have face value of 10 rupees. Some companies may have face value of 5 rupees. Or some companies may have face value of 100 rupees.
Yes, sir.
Okay. And this is one point, face value. Another thing is the lot of shares issued also are different. Some companies may issue only 1 lakh shares. Some companies issue 2 lakh shares. Some companies may issue 10 lakh shares, depending on their needs.
Yes.
So, the quantity of the shares issued are different. The face value also is different.
Yes.
But all these companies are listed. All these companies are listed. Let us say, company 1 is listing, okay, at a face value of rupee 1 with 10 crores. 10 crore shares and 10 crore rupees. Face value rupee 1. Okay. So what is the value? 10 crores. How many shares? 10 crores. Okay. This is company 1. Company 2. Company 2 issued, okay, let's say 1 crore shares. Okay, 1 crore shares it has issued with a face value of 100.
Okay, sir.
100 into 1 crore. Shares are 1 crore. Face value 100. 100 into 1 crore, 100 crores.
100 crores.
100 crores is the value. First one is 10 crores. Second one is 100 crores.
100 crores.
The third one has a face value of 10 rupees and issued 5 lakh shares. 5 lakhs into 10. How much?
50 lakhs.
Or let us say 10 lakh shares it has issued. 10 lakh shares. So 10 lakhs into 10 rupees.
Okay.
10 lakhs into 10 rupees. Means 1 crore.
Yeah.
Okay. So third company has 1 crore value. Second company has 100 crores value. First company has 10 crore value. Okay. Now, what is the total of these 3 companies? The total value of these 3 companies. 10 plus 1. 10 plus 100. 110 plus 1 plus 1. Okay. 100 and 111. 111 crores is the total value of the shares listed. The total worth of the shares listed in stock exchange and issued to the public. Okay.
Yes, sir.
Right? That is the total. Now, what is the proportion of? What is the weight We call it weight. What is the proportion of company A in the total value of the Bombay Stock Exchange? Let's say instead of 3 lakh, I'm saying only instead of saying 30 companies, I'm saying only let us say 3 companies. For convenience sake, I have put only 3 companies. For convenience sake, it is just for convenience. Okay.
Yes.
So when it is 3 companies, then 3 companies, right? When it is 3 companies, total worth of these 3 companies listed in Bombay Stock Exchange, 111 crores. 111 crores is the total, and the proposition of company A is 10 crores by 111 into 100, or simply 10 crores by 111. 10 crores by 111, how much? Can you just use your calculator?
10 by 111.
10 by 111.
0.09.
0.
It's like 90%.
90%? Okay. 90%? 9%. 0.09 means 9%, not 90%.
Okay. Yes, sir.
9%.
9%.
Okay.
Yeah.
Then let's come to the second one. 100 by 111. If you multiply with 100, it will be 9%. Got it? 100 by 111. Hello? Can you hear me? Hello, can you hear me?
Yes, sorry, sir. I got a call from my colleague.
No problem. Absolutely.
Actually, I'm working and listening. That's the reason they are calling me.
No problem. And actually, it should be out of the office hours, the classes, because it's an executive program. It should be out of office hours.
Luckily, we are having work from home. That's the reason I'm able to attend these.
Otherwise, and that is why I'm also, I am not, some teachers may be offended, but I do understand, I'm also a working man, and I know what are the work pressures. So it's all to adjust.
Yeah, sir. It will be 90%, sir.
How much you got? 0.90.
90.
0.90 means 90%.
90%, yes.
90%. Then the next one is 1 crore by 111. 0.01.
Yes.
0.01. So the weights are okay, 0.01, 0.09, okay, and 0.9. These are the weights. So based on this, they will assign some marks for these weights. Let us say 100% for 100%. Each percent there is 1 point.
Yes,
okay,
sir.
each percent there is 1 point. Now, let's say for 90%, 9 points, 90
Yes,
points. And 10%, 9%, 9 points. 1%, 1 point. So 100. As of now, in 1978, it is 100.
Yes,
Now,
sir.
after 1 year, what happens? In the market, this 100 crores will become 1,000 crores. So when it becomes 1,000 crores, okay, 100 will become 1,000.
Yes, sir.
And likewise, 10 has become 50, let us say. 50, it will become points. So 1,050. And 1 will become 10. So 1,050 plus 10, 1,060. 1,060 will be the index. Okay. So the market capitalization of company A, market capitalization means their face value is 10 crores when they have issued, newly listed and issued. In the market, as it is being traded for over the years, first year, second year, third year, fourth year, and goes on. As it is being traded, its value has come up from 10 crores to 100 crores. Okay. And when the value of that company's shares are increasing, the index also will be increasing accordingly. Okay. Index also will be increasing accordingly. Are you getting me?
Yes, sir. Yes, sir.
So that is how, look at this. If you can type in 1992, sensitive index in 1982, just type it. Sensitive BSC Sensex in 1992, type it.
1992.
1992. BSC Sensex in 1992.
It's 25,500.
How much?
25.
25,000. 2,500.
No, sir.
2,500.
2 crores, sir.
Sensex, mark Sensex in 1992.
3,000.
2,500 or
mark in the week.
3,000.
3,000.
Okay. When Vajpayee was Prime Minister, it touched 6,000. When it touched 6,000, they said, India is shining, India is growing, so and so. Okay. So 6,000 was a big achievement in those days. What is the index today, which you have checked? It is nearly 60,000, 10 times it raised. Okay.
Yes,
so how it is raised? When there is a purchase and sale of shares in the market. Which market? Stock market. Where? Through stock exchange. When they are traded through stock exchange as a platform, because of the demand for those shares, when the shares will be demanded, when the company is doing well, when the shares are demanded, then there is, when the company is doing well, there's more demand for those shares. And when there's a demand, the price is pushed up, demand and supply rule in economics.
Yes, sir.
So that is how the prices for the shares go up. Okay. When the prices for the shares go up, the sensitive index also goes up.
That is how the sensitive index has come from 3000 in 1992 to 2022, let's say 92, 2002, 10 years, 2002, 2012, 20 years, 2012, 2022, 30 years. In 30 years, the sensitive index came. It is increased by how many times? Percentage. 3000 by 60,000 into 100. Check the percentage.
Yes, sir.
What's the percentage?
It's 5%, sir.
No, not. No. I'm sorry. 60,000 by 3,000.
By 3,000.
60,000 by 3,000.
It will be 50, I think.
Or you can say 60 minus 3, 57,000. 57,000 by 3,000.
One second, sir.
57 by 3,000 into 100.
57,000 divided by
3,000 into 100.
190 into 100.
No. 57,000 by 3,000 into 100. 57,000 by 3,000 into 100.
19%.
Not 19%, 1,900% maybe.
57,000 divided by 3,000
into 100.
Yeah.
How much? 1,900%.
Yes, sir, 1,900.
1,900% increase in 30 years. So, stock exchanges are the barometers of growth in the economy. In 30 years span, the stock exchange has grown by 1,900%, which indicates the economy, Indian economy has improved, developed, grown to this extent. 1,900% growth it has achieved.
Yeah.
That is a research you have made. I didn't do anything. Today, in today's class, you have done everything. Okay. And yes, this is what your project. This is how did you complete your project, SIP, summer project?
No, sir.
This is what you have to do. When it is summer project, this is how you have to do.
Yes, sir.
You can take a project like this and you can do, this is research. Okay. And only thing is, what we are talking, we will put it in black and white. That itself becomes analysis.
Yes, sir.
We'll do it when the project comes now. We'll do it, no problem.
Sure, sir.
Okay. Right, ma. Any doubt here?
No, sir.
Okay. And I'll do one thing. I'll take a break. Okay. I'll take a break. I don't know whether I will be able to schedule the Zoom meeting now on the same platform. Okay. Or you just take a break of 10 minutes, then I will join back. 15 minutes we'll take a break since we are only two. No. And meanwhile, you finish all your office, tasks, and then we'll get back.
Yeah, sir.
15 or 20 minutes? 20 minutes will take.
20 minutes.
Okay. We'll be in line. Okay, let it go.
Okay, sir. Okay. Sir.
Okay.
Shall we start?
Yes, sir.
Okay. You see this, no? Types
Yes.
of
Types of risk.
risk and return. Types of risk. This we're talking about is a bit different from the risk that we have discussed earlier. If you see this diagram, you keep your money in certificate of deposits, okay, notes, bankers, DDs, okay, and fixed deposits, government bonds, and things like that. They are secure, very low risk, very low risk. And sometimes if you keep in mutual fund, it is riskier than the previous one. And you keep it in options, futures, and so forth. This is highly risky. Okay. So these stocks or these investments are high risk. These investments are low risk. In between, you have middle risk. Higher the risk, higher the return. Lower the risk, lower the return. That is the rule of finance. That is the rule of fundamental rule of finance. Okay. Next, we'll go to types of risk. Yeah. Look at this. Modern investment analysis categorizes the traditional source of risk into two. Okay. Two. General risk, specific risk. Okay. Market risk, issuer risk, systemic risk, non-systemic risk. Okay. Systemic risk. You may have a short question on this systemic risk or systematic risk. An investor can construct a diversified portfolio and eliminate part of the total risk. The diversifiable or non-marketable part. The diversifiable risk is known as systematic risk. Systematic risk, diversifiable. Okay, the diversifiable part. What is the left is the non-diversifiable portion or the market risk, variability in the securities total return. Yeah. Non-diversifiable, diversifiable. What is this diversifiable? Okay, sir, you're talking about systemic and non-systemic. What is this diversifiable and non-diversifiable? Let us say you have 10 lakh rupees and that is an extra bonus that you got during the year, and you want to invest that 10 lakhs somewhere where that you want to invest in stock, because Ravi sir is teaching finance and security analysis, and let me try with actually how it looks like. Then you took the 10 lakhs and wanted to invest. So because you are new to the market, what you'll do, Infosys is a very good company. Let me invest there. You took all your money and invested in Infosys. And after 6 months, Infosys lost some of its contracts. And many people are laid off. And the revenue gone down. Profit became loss. As a result, the share price went down. As a result, you have sustained loss. Okay, all your 10 lakhs you kept in one type of stock. But contrary to that, if you diversify it, okay, no. If this stock goes wrong, then the other stock will save me. Let me keep it in Wipro. Let me keep it in Reliance. Let me keep it in Tata's, TCS. So you diversify all these 10 lakhs, in TCS 2 lakhs, in Infosys 5 lakhs, in, the stock that is more promising, you keep more money. The stock that is not very attractive for you, you'll keep less money. You diversify. Why do you diversify? Because if something goes wrong, the other stocks will take care of. That is called diversifiable risk. Okay, diversifiable. If you have the opportunity to do that, that's diversifiable. Okay, non-systemic risk. Variability in the securities total return. Risk means variability in the returns is risk. Variability. You expect 10 lakh rupees as profit, but you got only 5 lakhs. Negative variability is risk. Negative variability in the expected returns is risk. You wanted that stock to give you 10% profit or 20% profit, but it gave you only 5% profit. That is risk. What is risk? Variability in the returns. That is variability in the returns. Okay, right. Now, non-systemic risk. The variability in securities total returns not related to overall market variability. It is nothing to do with the market. Okay, it's nothing to do with market. This risk is unique to a particular security and is associated with such factors as business and financial risk as well as liquidity risk. Although all securities tend to have some non-systemic risk, it is generally connected with common stocks. Thus, the systemic risk is attributable to broad macro factors affecting all securities. Non-systemic risk is attributable to factors unique to a security. The sources of two major types of risk are systemic risk, unsystemic risk. Systemic risk is uncontrolled. You have no control over the market scenario. Okay, whereas unsystemic risk, it is controllable, it is diversifiable. What you cannot control is systemic risk because it's market forces which operate. It is not in your hand. Okay, whether to make profit or loss, it is not in your hand, but it is in the hands of the market forces. Whereas unsystemic risk, it is in your hand. You can diversify it. You can control, minimize the risk. That is unsystemic risk. Please ask me if any doubt here.
No doubt, sir.
Then systemic risk. What are the factors which are not in your hand? Economic factors, political factors, sociological factors. These are all not in your hand. So therefore, this is systemic risk. Whereas unsystemic risk, okay, you can diversify. Okay, business risk, liquidity risk, financial risk, credit risk, operational risk. They're all the risk associated with unsystemic risk. They are controllable, they are diversifiable. If you want, you can minimize this risk. How? You can work on liquidity risk. Okay, what is liquidity risk? Non-availability of cash. If you are a credit, if you're extending credit freely to your customers, what happens? You're giving credit to your customers. Ruthlessly, you're going on giving credit. What happens? In the due course, you have as you are liberal in extending credit, your creditors, your suppliers are not liberal, na? They will be after you to collect money from you for the goods they have supplied. So what happens? You want money to pay for so many obligations, but your customers are not paying because you're very liberal to your customers. That's called liquidity risk. Okay, credit risk, that is also default risk. Customers, when customers don't pay for the goods that they have purchased from you, that's credit risk. Operational risk is overall performance of the company. Okay, then business risk, financial risk, these things in detail. Business risk is doing business in a particular industry or environment is called business risk. Risk of doing a business in a particular or in a given environment is business risk. Then let's look at internal business risk, external business. Internal business risk is associated with operational efficiency. External business risk is associated with the conditions imposed by the circumstances beyond the firm's control. And probability distribution. Standard, these are statistics. Statistics, they are used for measuring the risk. Okay, risk and return trade-off. What is risk and return trade-off? Higher the risk, if you want higher profits, you must be ready to take higher risk. That's it.
Yes, sir.
and less profit if you want to. If you are satisfied with less profit, you don't have any risk. Simple. Those who are with the good companies like Deloitte, like you people, the kind of work that you are putting is more, na? Let's say you may have friends, na, in normal jobs also, who are just at clerical level. What is your designation?
MIS analyst.
Okay, management information systems
Yes,
analyst.
sir.
Okay, so it's not good to ask your pay, but I can say your pay is much superior to so many of your friends, na, classmates.
Yes, sir.
You will agree with this, right? So why
Yes.
the amount of pressure that you take is more than the amount of pressure they take, na? For them,
Yes.
for them, deadlines are not very important. Tasks are not at all relevant for them. Man rahe to they do it. Otherwise, they simply go, and when they are going also, they go without permission. When they're resigning also, they resign without permission. When they don't have joining report, they don't have any work culture. So, that's why their salaries are very less. But if you want a systematic, and if you want to take a risk, you take why politicians, these days I'm analyzing, politicians are very corrupt, and that's what the feeling in the market. But I say it is they're not corrupt because the amount of risk they take, nobody takes, na? They spend their money, crores of rupees, they spend their energies, they sacrifice, so much of time from family and to be in the public. For that, if they're making 500 crores or 1000 crores, that is, yeah, that much risk they have taken. And if you want, you can also take. And don't give the excuse that, I don't want to be corrupt. No, you don't want to be workaholic. You want to be lethargic. Therefore, you give the excuse that I will not be getting into bribe. No, no, nothing like that. You are, even to take bribe, you must be efficient enough not to prove. You must prove that, that's legal. Otherwise, you'll be caught. So they take high risk. The politicians take high risk, and they deserve what all the reward they are getting. Maybe in the form of bribe, maybe in the form of quid pro quo. Okay, whatever is the form, right? Their risk is high, their return also is high. Okay, so that's it. What is systemic risk? What is market risk? Risk arising out of the market forces. Okay, variability, negative variability in the returns arising out of market fluctuations, that is market risk. Okay, financial risk. Financial risk, return on yield, return or yield. Yield means percentage of profit you make. Okay, and previous question also we didn't see. Previous questions, see. You see previous questions. I think most of the questions. Yeah, Nifty. Nifty is for National Stock Exchange. Sensex is for Bombay Stock Exchange. The index of NSE is Nifty. Index of
BSc is Sensex.
most of the questions you can answer. Okay, if you read this material.
Yes.
I'm not allowed to share this material. They have strictly asked us not to share the material. Therefore, I'm not able to.
That's okay, sir.
Yeah, so this we have done. Yeah, beta. What is beta? What is alpha? Where is alpha? Systemic risk. Beta is the measure of systemic risk. Okay, alpha is unsystemic risk. Beta is systemic risk. Alpha is diversifiable risk, unsystemic risk. Okay, so don't get confused. Beta is systemic risk. Measure of, symbol of systemic risk is beta. Valuation models. Valuation of stock. Valuation of stock. Okay. So valuation concepts. Read this, we will discuss. Can you see this? Read it. You don't need to read outside. Read it for yourself.
Okay, sir.
What is the total number of students of your class?
I'm not aware, sir, actually.
The total list is not given to you.
No, sir.
Not given. Okay. Time value of money establishes that there's a preference of having money at present than at future point. That person will have to pay in future more for a rupee received today. Okay. So that's a value. Okay. Present value concept I discussed when I was talking about, okay, financial management. Okay.
Yes, sir. Present value.
Yeah. Models of valuation. Dividend model. Dividend valuation model is conceptually a very sound approach. According to this approach, the value of equity share is equal to the present value of dividends expected from its ownership plus the present value of the sale price expected when equity share is sold. Understood? It is equal to the present value of the dividend that share gives you over the, let's say you bought Infosys share and kept it for 10 years. Every year it is giving 10% dividend. Okay, every year, next year 10%. What is the present value of next year 10%? What is the present value of third year dividend? Present value fourth year, fifth year, sixth year, up to 10th year. What is the present value of dividends for 10 years of the Infosys stock? And now yesterday we have seen 1678 is the price. And that 1678 price dividend, when it is sold for 2000 or 3000, let's say 3000 after 10 years. Okay, that is the meaning. Plus from its ownership plus present value of the sale price expected when the equity share is sold. After 10 years, this share gives you 3000 after 10 years. Okay, so what is the present value of the 3000 you receive at the year 10? That is the meaning. Okay, 3000 which you receive after 10 years now is, let's say, 900. And the dividends that you receive yearly, okay, 800, 1000, 2000, like that, you're getting the present value of all those dividends for 10 years comes to, let's say, 4800. 4800 plus 900. Okay, 900. Right? So that is the value of dividend. That is the value of dividend. Okay, look at this simple model. Constant dividend model with no growth. A simple model of equity share valuation has assumption that dividend per share remains constant year after year at value D. Dividend will be received at the end of 1 year from now and required rate of return of market is R. Look at this. Market low, agar aap invest kiye to you will get interest rate R. Okay. But you kept in the stock market from keeping it in the market, from keeping it elsewhere. Then the value of such equity share is equal to V is equal to D by R. What is that? V is the price to get a return, and R is the internal rate of return or required rate of return. Required rate of return is R. So D by required rate of return. Okay, D by required rate of return is the value of share. Dividend by required rate of return is the value of share. Okay, and if there is a growth, value is equal to dividend by R minus G, growth rate. Growth rate. And there are three types of companies: high growth companies. Okay, high growth companies. Where is it? Where is that? We missed that. Oh, this one. Huh? Yeah. High growth companies. Okay. Then, yeah. Only one model here is given. High growth companies. Right. High growth companies. Simple valuation model proposed for companies that have a high growth in dividends currently is 2 stages. All right, high growth. There are 3 types of companies: high growth companies, normal companies, and low performing companies. That is not given. Without giving that, straight away he went to the next point. That is our confusion. Okay. So he said the intrinsic value of stock is equal to the total of the present value of dividends of year N plus present value of terminal value of that stock. That's what I said. So the present value of 3,000, present value of 3,000 plus the present value of all the dividend flows that you get for 10 years is your value, is the value of the stock. That's the meaning. All right. So you have, an example. You have an example. Okay. There's a problem. There's a problem. All right. What is the problem? Suppose that we buy one share of X company at the beginning of the year 25. Okay, we hold the stock for 1 year. 1 rupee in dividends is collected at every year. 1 rupee every year, and the share is sold for 26.50 paise. The rate of return achieved in the composite of dividend yield and change is price in the price. Thus, look at this. Dividend yield is equal to D by P. 1 rupee dividend by price of the stock 25 gives you 0.04 or 4%. Then you bought at 25 rupees and you sold at 26 rupees. Okay, by 20 difference, by 20 difference is 1 rupee 50 paise. 1 rupee 50 paise by 25 gives you 0.06 or 6% capital gain. There's a dividend yield, there's a capital gain. Put together is your total rate of return. 4% plus 6%, that is 10%. Okay, 10%, right? So therefore, P is equal to price of the share is equal to D1 by 1 plus R plus P1 by 1 plus R. D1 by 1 plus R, P1 by 1 plus R. Okay, D1 by 1 plus R. 1 R is rate. What rate? Required rate in the market, the common rate of interest. Okay, so this gives you price of the share. Look at this problem again. Yeah, look at this. Should a rate of return be 15%? If the rate of return is 15%, okay, and the purchase price would have been too high. At purchase price is 25. Okay, and the selling price is 26.5. To achieve 15% rate of return, the value of what is the value of stock? Value of stock is equal to 1 rupee dividend, 1 rupee dividend by 1 plus R. R is 15%. Okay, rate of return, normal rate of return is 15% or 0.15. 1 plus R. Okay, plus the selling price 26.5 by 1 plus again R, that is equal to 23.91 is the value of share. This is the model. Which model is this? 1 year holding yield method. Yeah, this is yield method. Okay, holding period if it is 1 year, and if it is multiple year, there's another formula. Okay, dividend discount model. Like this, you can go on, yeah, checking this formula, and it is easy to follow. It is easy to follow, right? There is CAPM, capital asset pricing model. Look at this. We will just have a look at this, then close it. Capital asset pricing model. Okay, what is this? This formula. Yeah, value of the stock is equal to beta of the stock into market value of the stock minus market return minus, okay, risk-free return plus risk-free rate. Okay, this is the value of the stock. Required, I'm sorry, not value of the required rate of return is equal to beta of the difference between market return and required rate of return plus risk-free rate gives you this value. Okay, so you must ask me if you have doubt here. Where is this? Where is this? Oh, this one. You ask me if any doubt is there.
No, sir.
No doubt. Here. I'm trying to make the formula simple. Look at this. It is like this. Expected return. Okay, is equal to expected return is equal to, I'm just simplifying. Okay, beta, you know now?
Yes, sir.
beta multiplied with, okay, beta into, okay, beta into risk premium or risk premium okay, into risk free rate. Okay, risk free rate RF. That's it. I tried my best, ma. I'm not used to this. I just tried my best. Okay. So this is the formula. Expected rate of return is equal to beta into risk premium. What is risk premium? Look at this risk premium. Risk premium is this. Okay. What is that? Market return okay, minus risk free return. Risk free return. That's it. That is equal to risk premium. That is our meaning here. Look at this. Beta, I wrote beta, market risk minus risk free return. Market return minus risk free return, which is called as risk premium, multiplied with risk free rate. Oh, this is not multiplication, this is plus. This is plus risk premium. అంటే దాని అర్థం ఏంటంటే post office savings scheme gives me 6% anyway, 5% risk ఏమీ లేదు. That's called risk free rate. Okay, that is risk free rate. If you want me to invest in stock market, how much I'll get? I will get, you're saying I will get 10%. What is 10%? Market return. Okay, so market return is 10%, risk free rate is 5%. 10 minus 5, 5 plus risk free rate. Risk free rate is 5. So 10 minus 5 plus 5 is equal to 10. That is a return. That is a return. That's it. Okay.
Yes, sir.
So we'll stop here. Too much is going on. We'll stop here. You just go through these examples, okay, and feel free to message me about the explanation. Okay. Yeah, fundamental analysis. Fundamental analysis comprises of, this one is another important thing. Fundamental analysis comprises of fundamental analysis comprises of economic analysis, company analysis, industry analysis. These three analysis you learn. There will be one essay. Company analysis means, analyzing the company financial statements. Industry analysis means in addition to this, you are analyzing the market factors, that is industry factors, that is industry analysis. In addition to this industry, you analyze so many other industries also. Okay, let's say cost of car making depends on the cost of steel, aluminum, because they are the main ingredients, na? It is like that. Okay, so you have to analyze the economy as a whole. This is economic analysis. Right, then fundamental analysis is one more important area. I just want you to read it, prepare. Okay. Then technical analysis, company analysis, all this. Okay. We will close it now. Okay.
Yes, sir.
Yeah, we'll close it. Thanks for your patience. All the best. And if
Thank
any doubt, and mail your doubts or message, and don't expect immediate answer. Okay, but I will answer. I will answer the doubt.
Okay, sir.
Right. You take care.
Bye.
Bye.